This is the Resilient Advisor Podcast. My name is Jay Coulter, and joining me for this episode is Brad Johnson of Advisors Excel and the host of the Elite Advisor Blueprint podcast. Several years ago, one of my biases around constructing financial plans was an extreme distrust of reverse mortgages. Then I started to notice a lot of my clients were incorporating them in their financial plans, so I wanted to learn more. I invited Dr. Wade Pfau on the podcast. He walked me through the academic case for having reverse mortgages in a plan, and I was sold that there was an application for that. Recently, I'm running into advisors using fixed index annuities inside of their plans, and instantly I have an aversion to it. It's generally because of my bias towards it, the way I came up through the industry, but I wanted to learn more. I went out onto my social media networks and I asked the question, who can I talk to about fixed index annuities where I'm going to get not a sales pitch, but an academic reason for putting them into a financial plan? Without question, the number one name that kept coming up was Brad Johnson. Brad, I appreciate you coming on the podcast.
Glad to be here, Jay. Thanks for having me on.
All right, let's get right to it with where my biases lie. All right, fixed index annuity sales hit a record $69 million in 2018, and according to the LIMRA Secure Retirement Institute. But several years ago, under the threat of the DOL's fiduciary rule, sales of all annuity products, including fixed index annuities, dropped. And the thought is it had to do with the potential for class action lawsuits. It looks like only once the threat of the DOL's fiduciary rule was removed, people started using them again. For a skeptic like me, Brad, how is that not the first put off as it relates to adding them to a plan?
Yeah, I think it's interesting, Jay. And so like to give a little bit of background, just so people know kind of where I came up through the industry and where my experience comes from. So I started with Advisors Excel 2007 as the 12th employee. We were a tiny little insurance brokerage company, middle of nowhere. Most people would say it's Topeka, Kansas. Most people just fly over. And so really grew up in the fixed annuity space. We brokered that product for independent financial advisors, which I know is a big part of your audience. And really because I have seen a lot of biases, and it's cool that you recognize it based on where independent advisors came into this business, how they were trained up, who their mentors were, who the companies were they worked for. And so I come from a very insurance-based background where we came over to the asset management side. So now we have an RIA that'll oversee about $10 billion, grown over the last 4 years. So I came from an insurance background, came into the asset management side where I see a lot of people similar to you. You maybe came from more of an asset management background. And now there's this merger of all of these worlds converging, especially for independent advisors, and trying to figure out, well, as a fiduciary, how do I truly look through all these tools that exist that I'm able to put into portfolios for a client? And how do I sort through all this noise, basically? So to get to the 151A question, there's been different versions of that proposal over the years since I've been in this industry. And typically most of it just stems from suitable sales. How do I make sure that I'm providing for my clients what's in their best interest, the fiduciary rule, right? And a lot of the uncertainty around that rule, and I'm not a lawyer, so I don't want to go too deep here, but really there was a massive uncertainty, and the way that legislation was passed down, it was literally passed, and then like there was a 6-month time frame, a year time frame, and it wasn't just the insurance side. Broker dealers didn't know how they were going to oversee it. RIAs didn't know how they were going to oversee it, and there were just a lot of questions on how do I know that if I'm positioning this thing inside of a client's portfolio, how do I get paid? How do I disclose how I get paid? And then what are the consequences down the road based on that decision? And how do I need to prove that was in the client's best interest? And so I would say it wasn't just the annuity space. It was all kinds of products and how those fit. And so, yeah, I think there was definitely a blip when it comes to sales. And I think a lot of it just came to uncertainty and the pressure of how to comply to these new regulations, which I mean, we were dealing with some of the largest BDs in the country, and they didn't know how they were going to get to the finish line based on the proposed deadline. So I guess I wouldn't just limit it to the insurance space. It was definitely kind of across the board on all fronts. So sorry, that's a long answer, but that's just kind of a 30,000 foot view.
It's definitely a fair answer, but the first thought I had as it relates to advisors allocating to fixed index annuities had to do with that data point for somebody who's not as experienced with some of these insurance products. What I think would be the optimal exercise for you and I and for my audience, mostly financial advisors that are on the independent space that may not have considered these for their portfolios. Let's go through a thought exercise, almost a role play. And as you know, advisors are typically cynical, skeptical, and a little bit stubborn. But I'm going to be open-minded, and let's pretend like I'm an advisor with $150 million book of business, never really use these as part of the planning process. I'm on a hybrid platform. I'm planning centered. I have a CFP. Tell me why I need to go through the exercise of considering these for a client.
So my first question to you, Jay, would be, how are you generating fixed income? Well, and I guess I need to step back for a second because I know every audience has a different clientele or every advisor has a different clientele they serve. Where I would say fixed indexed annuities, typically where they're going to be best fit inside of a portfolio is for retirees, is for people that need to generate fixed income off of a portfolio. So typically for most of our advisors, that's going to be somewhere 55, 65, 70 age range. So I just want to make sure I'm not making any assumptions on your case study there. Are we good with that assumption, fixed income?
I think that's very fair. And let's even, so this is not meant to be confrontational. In this role play, I've reached out to you because I want to see what the options might be to use fixed index annuities, because as a Gen X advisor advising baby boomers, and I plan on seeing them through retirement. As I came up through this industry, I'm pretty proficient at fixed income, and that has been the ballast for generating income for my clients.
Perfect. Okay. So my first question to you, Jay, would be how are you currently generating fixed income in most of the portfolios that you oversee? And I know that's a broad question, but let's just get a basis for kind of where you're at, or maybe where most of your listeners are at for fixed income.
Yeah. So let's say it's a bifurcated strategy using either ladders with corporates and treasuries that I've been doing throughout the past 10, 15 years. So I understand the interest rate risk that I have, not just risk, the interest rate exposure that my clients are experiencing. And I've been mitigating some of that with these, core fixed income mutual funds that have some ambiguity to how they're structured.
Okay. And what's a conservative return or income that you're looking to generate off of that piece of the portfolio?
So that would speak to a specific client example. Maybe I defer to you on what most folks are looking for when you're having these conversations at the practice level.
Yeah, I think it's really tough right now. It's tough to be a financial advisor that's trying to generate income off of a portfolio because look at the interest rate environment we're in, historically low, right? So I'd say most of my offices, if I say off of a bond portfolio, what is a conservative estimate? They're going to give me right now somewhere between 2 to 3%. Do you think that's fair?
Potentially. Let's go with 3. Could we do that?
3. Yeah. Okay. So 3%. So basically and this is I'll give you some academics that support this because I don't want your listeners just think, hey, this is Brad's viewpoint. The first thing I think that you have to go to is you look at financial services, and it's constantly evolving, and especially with technology that's just sped up over the last 5 to 10 years. And I think the first thing, when you hear the word annuity, most people don't get warm and fuzzies around that. And when you truly define an annuity, it's just a contract that creates income down the road, typically, right? But the issue is that there's multiple types of annuities. There's FIAs, so basically think pension, right? There's fixed annuities, think CD, like I'm just giving, the generic closest thing that most advisors would be familiar with. There's variable annuities, think mutual funds with an insurance wrapper around them, or ETFs. And then there's fixed indexed annuities, which were invented in 95. And the most recent addition to that family, which really sits as a hybrid between a fixed annuity and a variable annuity, right? And so the first bias that I see out there is people lump or advisors and consumers for that matter, there's just such a lack of education on the different types of annuities and the different uses of annuities. So I think you really have to start from like 101. And then no different than anything, as an independent advisor, the beauty of it and why we see this flood to independence is most independent advisors want to control their own destiny. They want to build the most efficient plans for their clients, and they don't want like Big Brother looking over their shoulder telling them what they can and can't use. So if we start from that and kind of a true fiduciary, which is more access to everything is better than less and constraint. I just make the analogy, we've got a big toolbox sitting at our feet as an independent financial advisor. I honestly want to put everything in there. And then I want to sort through based on what the client's trying to accomplish in their plan. And I want to pick out the most efficient tools to get the job done, right? So if we start from that basis and we say all annuities, they need to be in the toolbox, but that doesn't mean we have to use them. No different than a mutual fund or ETF. There's good and bad of all of them. And then from there, what we want to look at is how do we generate fixed income in a portfolio right now? And so some studies, and we can link to these in the show notes if you want, Jay. A more recent one, Roger Ibbotson. I've got it here. I'm pulling some references out. He wrote a white paper, Fixed Indexed Annuities, Consider the Alternative. This came out in January 2018. But basically, I'm going to read a few cliff notes here. An FIA, and this is Ibbotson, an FIA may be an attractive alternative to traditional fixed income options like bonds to accumulate financial assets prior to retirement. And then he goes into fixed income and how that's generated. It's like a 30-page white paper. I'm not just going to read it to your audience here. But basically what it comes down to is when you look at the biases, typically when I speak with most advisors, it has to do with sales practices. Would you say, and I want to unpack your biases because I know everybody has different biases for different reasons, but it's typically the guy that was down the road throwing 85-year-olds into an illiquid product at too high of a percentage for their portfolio for a commission.
That's right. That's exactly right.
Yeah. And so and it's funny, like the podcast on my side, it's opened up these conversations just like it has for you, Jay, where I've got RIAs managing 500 million, $1 billion. And they're like, I'm trying to generate fixed income most efficiently in this portfolio. And there's kind of this, they've heard these things about fixed index annuities, but then there's this thing in the back of their head, but there's that one guy, Joe, down the street, can't stand that guy, right? And so the thing is just if you take that, put that on the shelf for a bit and just say there's bad sales practices in every industry. I don't care if you're an RIA, an insurance guy, whatever. And if we just lean on fiduciary and finding the most efficient tool to get the job done, when you look at fixed income in a portfolio, one of our most popular products right now, this very simple, and that's why people like it. It's a 50% par rate on the S&P 500 with an annual reset.
Can I stop you there? Can I stop?
Yep.
I bet most of my audience do not understand what you just said. Could you unpack what that means for the investor?
Yes. And that's the tough part is part of it is the complexity of these products. And there's so many of them out there. It's like sorting through the ones that are gimmicky versus the ones that are just very clean vanilla products that just perform for what they're used for. So 50% par rate, what that means, that's on an S&P 500 index. And so if the S&P 500 has a 10% return during the 1 year time period that index that crediting method was taking out, if the S&P has a 10% return, you get 50% of that credited at the end of the year for the client. So that would be a 5 in that scenario.
Does that include, in prepping for this podcast, and I know I told you before we recorded, this was one of the more difficult podcasts I had to prep for because I'm just not familiar with the space. Does that include the dividends being reinvested or is it a price increase?
It depends on the index. There are indexes inside of indexed annuities that do include the dividends on the S&P 500. Most do not, though. So in that scenario, the one that I'm referencing does not. But there's also multiple carriers, multiple indexes. So if dividends are important, we do have products like that do include dividends. The vast majority, I'd say 95% plus in our space, do not include the dividends.
Perfect.
So if it's a 10% return on the S&P at the end of the year, 5. If it's a 5% on the S&P at the end of the year, 2.5. And then going to a fixed income, and where most advisors, you've got your equities bond mix is pretty standard in the general portfolio out there. Where most advisors are going to fit the FIA is as a bond all. And so if the S&P in this example was a negative 20, we had a correction year, you would get a 0 in the FIA for that year. So you get a 0 return.
Going back to the performance return, if a client allocates to an FIA in March, do they capture 3/4 of the year's return?
So if it's in March, basically what would happen, let's just say it's March 31st, right? So March 31st of 2019 is when they got in. March 31st of 2020 is what it would run to. So it's a 1-year period based on when they opted into that crediting method, when the annuity issued typically.
Do advisors who allocate to FIAs use it as any type of market timing tool then? If there's a pullback trying to allocate at that time, is that a best practice? Is it discouraged?
Well, what's really interesting is the more familiar you become with the pros and cons of the product, you figure it can be like a Swiss Army knife that you figure out how to best use it based on how you build portfolios. So good example. Let's say a client came on 10 years ago, and let's say you did Riskalyze or some, risk assessment. And let's say at the time it was a 50-50 allocation. I'm way oversimplifying here, but just for this analogy, let's say 50% went into bonds, 50% went into equities. Well, fast forward 10 years, unless you're constantly rebalancing or however, it's going to be skewed a little bit, right? Based on the equity growth of the last 10 years, maybe it's closer to a 75-25 now, 75 equities, 25 bonds, just based on the growth on the equity side. So where some of our offices will do is basically assuming market growth, they'll take, and assuming also as you go along, you're getting closer to retirement age, which most experts would say de-risk the portfolio the closer you get to retirement and needing the income. They might say it's almost like on the blackjack table, you'd take a few chips off the table, put them in your pocket, right? And so they might take some of the growth off of the equity side, put it into the indexed annuity, because now if the market corrects, those gains are locked in and they get a portion of the upside of the market, but protect versus the downside. And I think the biggest thing from a decades plus of conversations like this, Jay, the bad taste in advisors' mouth about an FIA typically come from, once again, the sales practice and the people they've seen with unsuitable sales that were made. And so I think the key thing is you really figure out what's the purpose of this inside of the portfolio and making sure the allocation's proper. And where I typically see it's the guy that jammed an older person into an annuity where they had illiquid assets. And the one thing I can say also, being in this decade for 10 plus years, it's actually like you could take a 75-year-old. It would be harder to allocate more money into a fixed indexed annuity with downside protection versus I could throw it all into a super aggressive triple leveraged ETF. And so the question is, what is suitable, what isn't suitable? And I think that's the core thing for great advisors out there. They're having those conversations with their clients and they're figuring out, how do we construct this portfolio to best serve them? And so, yeah, that's high level. I do have one other thing, and I'll just throw this. I like to base everything I do on math versus emotions, because I think emotions and biases can get us all in trouble. We have a tool that basically allows us to go back. This does a historical back test. So this was October 31st, 99 through October 31st, 2009, held for 10 years. Most of the FIAs are typically the top sellers in our industry are 10-year products, although I've seen the trend, especially as more RIAs get into it, trend towards 7-year and sometimes 5-year products. So based on how you want to build your fixed income inside your portfolio. So this was 2,516 different historical scenarios. Basically, they bought it, held it for 10 years, which was the term of the product. And on that 50% par strategy on the S&P that we referenced earlier, the worst that's done on annualized return over a 10-year period is 2.39% annualized over a 10-year period. The median return was 5.4% over a 10-year period. The best was 8.13. Compared to the S&P, negative 3.62 was worst, 5.13 was median, 15.12 was best. And so I think that's the other thing, and I'll get back to you so you can ask a question here. I would never compare this product to the market. And I think that's where a lot of advisors that were selling this versus actually placing it in a holistically built portfolio, they were selling. They weren't actually building a portfolio and placing it inside of a portfolio. And they would say, oh, you get all of the market upside with none of the downside risk. That is absolutely not the case. And that's an unsuitable thing to say. It's really, it really fits going back to a hybrid between a fixed annuity and a variable annuity. It's that middle ground where it should return slightly better than a fixed annuity. So if a product will do 2 to 3% in the fixed annuity space based on interest rates today, you might get a 4 or a 5 out of an FIA, which is why we talk about it as a bond alternative as a fixed income class.
Okay.
So that was a mouthful. Sorry, I'm throwing a lot at you, but
No, this is helpful. And that's the point of this particular podcast. So to go back, and this is going to show more of my ignorance on these products. If it has a 50% par, is that the cap rate term? Is cap rate the same term? Isn't it the same thing?
No. And that's, so let me give you some common crediting methods inside of FIAs, okay, and then how that's evolved over the 10 years. So 13 years, I guess, now that I've been doing this. So when I first got into 2007, your common crediting methods would have been things like an annual point-to-point cap. And so that might be at a 5 or 6% right now based on where interest rates are. So, and I guess let me go back to pricing. How do they price these products? So it's a fixed annuity. They're typically going out, most of the insurance companies buying mostly bonds because it's basically a fixed annuity. And then all they're doing is based on the interest rate they can get off of these bonds. They're basically going to take a portion of that interest rate and they're going to go buy call options on the said index, right? Makes sense. When people are like, oh, well, the insurance company's keeping all the money, all this. No, they're just, they'd buy 100% par on the S&P if they could. They just can't afford it based on the fixed interest that they're getting off of the bonds they're buying. So they're buying the most that they can in a call option. If at the end of the year, the market's down, obviously that call option expires worthless. If it's up, they're locking it in for a percentage that they bought it on. And so basically all of these different crediting methods, when you think about it inside of FIAs, there's only so many pennies in the dollar, and it's all based on what's the fixed interest rate they can get off of these bonds and what's the volatility. So what's the price of the options they're buying? Now, based on the crediting method they're buying, that depends on how expensive the options are. So look back the last couple of years. Great. Very until recently, not much volatility in the S&P. And so that led to option prices being fairly good when you look at uncapped par rate products. Now, volatility spikes and we get a lot of back and forth. Now those options get extremely expensive. And so if I was an advisor out there looking for, hey, what's kind of a best-in-class FIA? You don't want to buy an FIA that just has like 1, 2 crediting options. You want like multiple classes because based on the options prices, some are going to be better during some markets than others are. And so that's where I've seen some advisors get themselves in trouble where they loaded up everything into one crediting method and then the market changed and now those decreased as far as the crediting methods that they could put their clients' money into on each anniversary. And slow me down if I'm hitting anything that doesn't make sense here, Jay. So yeah. Let's
hang on, Brad. Can I ask you about that? So for the novice, the crediting option. So I allocate to an FIA at the end of the year. I get to, if they have multiple options, I get to choose which crediting option is used for the next 12 months.
Yes. Well, yes, maybe. So let's just, this is why I told you this is going to be hard to do in 20 minutes, right? So let's just start with like crediting methods 101, and then let's get into renewal rates on those crediting methods as the second part of your question. So the most common, an annual point-to-point, let's just say it's at a 5%. And let's just use that same 10%, the S&P return 10% over the 1 year, okay? So in a 50% par rate, if the S&P does 10 at the end of the year, you get 50% or half. So that'd be a 5. On an annual point-to-point with a 5% cap, if the S&P does 10, it's capped at a 5, so you also get a 5. Now let's say the S&P has a banner year. Let's say it does a 20. So in that first scenario, 50% par, 50% of 20, you would get a 10. 5% cap, annual point-to-point cap, you would get a 5 again because it's capped at 5%, right? So where a cap is going to outperform a par rate typically is those less impressive years, the 2, 3, 4, 5% years, because you're going to get all of it up to the cap, where you're only going to get 50% in a 50% par rate product. So let's go one more, just because I can tell you're getting really advanced here. So another one that's a really misunderstood out there is what's called a monthly point-to-point or a monthly sum, depending on which company that you're dealing with. And so all you're doing is that same math on the cap, except it's broken out by monthly returns. So let's say it's a 2% monthly cap. And here's the issue with this. It's not based on the total return at the end of the year. It's based on the return at the end of each month, which is why this stuff starts to get a little bit overwhelming sometimes to advisors, which is why, honestly, most of our RIAs go very simple as they're starting to understand, because like the 50% par, that's very simple. It's easy to explain to clients. They get it. And it's easier for the advisor to understand how it works. A monthly cap or a monthly sum is a little more advanced. So that, let's say it's a 2% monthly cap. Now it's based on each of the 12 months returns in that year. So let's say the first month does a 4%, let's say a 3% return in the S&P. You'd be capped at a 2. Let's say the next month does a 2. You'd be capped at a 2. So now it's 2 plus 2 for those first 2 months. Let's just keep going out, and let's just say it's 2, 2, 2, 2, 2, right? Let's say the first 11 months you cap out at the 2. So now you have a 22% potential return at the end of the year. Obviously, 22% return at the end of the year, which would be an amazing year in the S&P. But let's say that last month there's a big correction. Let's say there's a negative 10 correction that month. Well, in a monthly cap, you're capped on the upside. You're not capped on the downside. So you're at a 22. That last month's a minus 10, 22 minus 10. You still ended with a decent year at 12. Yes, 12. But you took a really big hit at the end of the year. So where a monthly sum or a monthly cap does really well is in a very bullish, low volatility market, because you can really get a lot of upside. And so that's why oftentimes what we'll do when we're coaching advisors and helping them understand these products, just like you would diversify a portfolio, we most often recommend diversifying among index crediting methods, because certain ones are going to perform better during different markets. But if you look historically, pretty much all of them are going to get an extra 1 to 2% on top of a fixed income in most scenarios historically over time. Is that helpful?
Yeah, it's very helpful. I definitely have a better grasp on, par versus cap. I'm thinking through this from the advisor's perspective. So, Brad, most of the clients I work with or prospects I talk to, one of the first conversations we have is about taking your investment process, making it rules-based to not only help scale, but also better serve the clients. Mm-hmm. And it's quite a chore. It's a real task to implement full rules-based investing for your stock portfolios. Mm-hmm. I'm listening to you talk, and I'm thinking about the advisors that struggle with rules-based stock portfolios and how they would apply some type of system to keep up with a book of business where there are 100 households, 50% of them have fixed index annuities, and they all have these different terms to them. What are the best practices? How do advisors go stray on that? And what's your guidance?
That is a tough one. And that's honestly one I think not just our industry, our advisors we work with, but the financial services industry in general. Look at fintech over the last 2 to 3 years. I mean, we should have gone and started a company because we'd be doing okay for ourselves. But what you have is this. Let's look out at the next 5 to 10 years. And here's what I would say. We're going to continue to see consolidation. We're going to continue to see this merging of worlds where the client doesn't care if you're an RIA or someone that deals in fixed. They just want best-in-class solutions to solve their problems. That's all they really want. And I think the thing that the industry has to get a lot better at is using fiduciary, the definition, versus fiduciary, the marketing term. Because I see a lot of fiduciaries using it as a marketing term. I see a lot of advisors using fee only as a marketing term, where truly what the client, let's go to their side of the desk, what they want in a fiduciary is you have all the options in your tool belt, and either have a grasp and you're an expert at them, or you have connections with people that are experts in those different fields, right? Or different products or tools. And based on the client's need, you're rummaging through that toolbox of financial tools and you're pulling out best in class to most efficiently fix the problem. So to your question, Jay, our technology has to get a lot better. Our firm has spent multi-millions to try to get the insurance world to talk to the asset management world. Nobody's done it yet. I mean, I would love if somebody hears this and they have a solution, please let Jay know, let me know out on Twitter or wherever, because there isn't a technology. I mean, the Orions of the world, on that side versus on the, what I would call the financial planning software side, the eMoneys, the Money Guide Pros out there. Nobody's solved this problem yet. The one that does is going to do really well for themselves, because we've had to hard pull these insurance companies and the data feeds to get them to actually plug into Orion and some of the different tools that our asset management side is using. And so to truly get to the end of that, technology has to catch up, because that's where a lot of advisors also have frustration. It's hard enough to grow a financial services practice, to convince people to give you their millions of dollars that they've saved over their lifetime and let you oversee it. But then if your technology has a disconnect with your clients, it's that much harder. So we're getting there, Jay. I think going back to rules-based, many of our offices are using tools like Riskalyze to get proper asset allocation when it comes to just risk tolerance. And then I kind of look at it like you're building McDonald's. You've got, value meal 1 through 5. I'm way oversimplifying this, but just for this conversation. And let's say based on those risk profiles that are personalized to the individuals, you've got a 1 through 5 with asset allocation. And then what I would recommend if I was an RIA out there that wanted to explore FIAs, it's not a replacement for bonds. It might be a diversification inside of the fixed income portion of their portfolio. So I would never say just throw out all the bonds you've been using for the last 30 years to build portfolios. What I would do is I would do an apples to apples comparison, get with the firm, obviously we specialize in it. There's other firms out there that do too, that know the space and can basically say, hey, here's a conservative rate of return when it comes to fixed income, if that's what the goal of this portion of the portfolio is, and then just compare it to what you're using in the bond space and say, okay, that does or does not fit based on how we're trying to use it. So I love rules-based. The technology is not quite there to automate all of it, although it's good example, 2018, let me get my years right here. 2018 in our space, I think we had 20% of the applications coming in on the annuity side that were electronic based. 2019, over 80% now, I think. So the insurance companies are actually adapting and starting to make this a little more seamless, as it has been on the asset management side for a long time, but they're still getting there when it comes to rules-based stuff.
One thing you just said about FIAs not being a replacement for fixed income, but helping to diversify it, I tell you, that resonates with me, and I'm pretty sure that resonates with people that might be exploring FIAs as a way to help. So let's talk a little bit just about your firm and firms like yours and how they would help an advisor. So going back to this role play where I have $100, $150 million, 100 households, I have an assistant and an intern. I just don't have the bandwidth to go and learn all this stuff. How would that type of advisor work with an organization like yours? What are the benefits of associating with that type of firm?
Let me give you a real life example, because you just made me think of a guy that's a really good dude. I'm not going to share his name on here, but his previous role, he was a CFO for a large company. I think they were Fortune 500. I'm not sure quite how big, but a large household name out there. So he was a CFO. Vast amount of financial knowledge. I mean, he could have taught me a lesson on a lot of things. And same conversation like we just had, Jay, is like, help me understand where FIAs fit. And so what we did is we're just like, hey, Chris, let's get on the phone and let's do a screen share. We use Zoom just like we're using to record this. And we just pull up this. Well, it's exactly how I did this analysis right here. We have a tool that will go back and just plug in based on crediting methods, based on real life historicals, and actually do a Monte Carlo on how this product would have performed over time. And so I just like to do the math and the analysis. I don't like to pull emotions and biases into this stuff. And so for Chris, we just said, hey, you're using bonds for this portion of your fixed income. Here's how this could compare. And I think high level, here's kind of 2 or 3 things that advisors like. So everybody out there, and I think this robo-advisor phase where everybody was scared of them is kind of worn off a little bit, but I still hear fee compression a lot, and advisors are concerned about that. So the nice, and this goes back to, all right, so I'm going to try not to stir up a hornet's nest on your audience here, but I think it's really something as an advisor I would be very, very careful and guard myself against is wearing this fee-only badge like a badge of honor. Now, I'm not saying there's anything wrong. 90 to 95% of our advisors manage assets and oftentimes do a lot more of asset management than they do annuities. But basically, if I say I'm fee-only, then going back to that toolbox, I just eliminated a bunch of tools out of that toolbox, at least as the world stands today. I know if there's annuities that are trying to bridge the gap into the fee-only space, and that's still working. But as an independent advisor, my goal would be put as many tools in the toolbox as possible and then pull the best in class out. So going back to that, when you look at how a portfolio is constructed and fee compression, most FIAs, if it's a 10-year product, they're going to be somewhere between a 6.5% and 7% commission, kind of industry average right now. And so where I think a lot of advisors, they get up on their soapbox and say, commissions are bad. I mean, we work with some of the largest broker dealers in the country. And what's funny, I had a philosophical question with the guy that knows this stuff, and he oversees all the VA space, all of the FIA space, all of their bonds. And so he's got a good comprehensive view. And he looked at the first couple fee-only annuities that rolled out, and he said, if I'm doing an apples-to-apples comparison, the commission version is better than the fee version.
Tell us a little bit about that. Why is it better?
Well, think about this. So let's say I create, let's just use 50-50. That's easy math. So let's say 50% in equities. You're doing whatever strategy you do over there to maximize growth. 50% in fixed income. And in a fee-based annuity, well, let's say the market corrects 20%. Well, the market corrects 20%. And now on the 50% that was fixed income, I just still charged a 1% fee on that, right? So in my 50% safe, or how basically you're allocating on that side to protect against the downside of the market, I just lost 1% on half the money in a fee-based FIA. If it's a commission-based FIA, I got a 0 for my client that year. And if you just look at the math to compensate the financial advisor that's doing the work, if I've kept my money in a 10-year fee-based FIA, that's -10 to that client in any year. Positive market, negative market, doesn't matter. If I take a 6.5 to 7% commission and just do the math divided by 10, 0.65 to 0.7 on average per year, it actually cost the client less, and they were protected on the downside, right? There wasn't a fee coming off in those down years. So the first way that a lot of advisors going back, and same thing with bonds, like unless you're not charging a fee to oversee a bond portfolio, if you're getting a 3 and charging a 1, the client's already not happy about the 3. So 3 minus 1, now they're down to a 2. In an FIA, if you can get a 3, 4, 5, which is what we're seeing right now based on historicals, -0, you just bumped up the alpha on your client's fixed income side. You decrease their fees that are coming off their portfolio every year. So you decrease their fees, potentially increase their upside on their fixed income, and you eliminated interest rate risk, to your point. If interest rates eventually someday do start to climb, that doesn't fare well for bonds. It doesn't impact the FIA as far as the free withdrawals and the liquidity there.
So for the folks listening that are upset by some of those comments, let's go a little bit deeper on the actual fee-based FIA and the applications. Are you saying to not use them? Are you saying there's not a place for them? And where have you seen flows as it relates to allocations to fee-based versus commission or transaction-based FIAs?
So the first thing I would say is I appreciate how you framed the beginning of this conversation, Jay. You knew you had biases and you admitted it. I know I have biases. We all have biases. We're human beings. So I think if you're going to truly embrace the fiduciary in any aspect, in any financial tool, you've got to set these beliefs on a shelf for a little bit and just do unbiased analysis based on whatever thing you're trying to fix or solve for in your clients' portfolios. So I really think, and I can't speak for insurance companies, but if you look at where is the money out in the world, there's a lot on the asset management side of the world as far as currently charging a fee to oversee those assets. So insurance companies aren't dumb. If they know, hey, there's biases against commissions, and if there's people advertising I'm fee only, I'm a fiduciary, we need to build a product that fits that mold. And I've had conversations, I can think of one right now, very successful household name, oversees 10 billion plus, probably 20 billion now of assets. And because the way they marketed their company was fee only, he's like, man, that product makes a lot of sense, but it wouldn't fit our model because we've marketed ourselves as this whole time, and that blows it up, right? And so I think part of the reason fee-based FIAs exist is because it's an untapped market that insurance companies want to get into. I think based on right now, if you look at using it as a fixed income alternative inside of a portfolio, I'm not aware of a lot of products that you could argue and say this is a better version because they've stripped commissions out and made it fee-based, just back to the original point I just made, right? It's not actually cheaper to the client. In fact, in a lot of instances, it's more expensive. And so if you have a bias against the word commission, I would just say do the math. Don't make commission a bad word. Just do the math on what it costs your client and then come to a conclusion and then figure out which one makes more sense for them.
I really appreciated your analogy of the 10-year product and paying a 6 or 7% commission, and you're paying 60 to 70 basis points over the term. I get it. It makes sense. One product that I really am not a fan of are unit investment trusts. That is the same argument that unit investment trusts make, which makes sense mathematically, but what happens is the advisor ends up selling out of the product and then buying another product, creating a transaction commission, and it's never in the client's best interest. As it relates to the FIA space, does that happen? So if I allocate $100,000 in a $2 million portfolio to an FIA, and 5 years down the road, am I able to go and swap it out for another FIA and create another commission?
Now that's a broad question with a lot of different underlying other things. When it comes to compliance and suitability, let's just talk about churning. Let's just get the word out there because it goes back to what's another bias that advisors have out there. There was this guy down the road from me, and he was just churning clients' money, and it was all about a commission for him. Has that happened in our industry? Yes. Has it happened in not just the annuity industry, but others, to your point, Jay? Yes. REITs, non-traded REITs happen all the time, right? And so I will tell you from a compliance and suitability standpoint, it's almost harder to put money in an annuity these days than it is, like I said, to put an 85-year-old's money in a triple leveraged ETF. And quite honestly, probably is. If somebody wants to test that, please don't. But so the short answer is typically what's going to happen is they're going to look at the surrender charge on the product. But if it's out of surrender, so if it's a 5-year product and it's out of surrender, technically they can take that money and put it anywhere. They could go throw it in the market. They could go throw it in wherever they chose to. If it's a 10-year product and they're only 5 years in, typically there's going to be a surrender charge probably around 5% by then. It's going to be different on every product, so please don't take that as gospel, but call it 4, 5, 6%, somewhere in there, where you're going to have a really good reason why that makes sense for the client, why that's in their best interest. And so I would say most products, it probably wouldn't be an option.
And so it's a mathematical exercise again, like you and I are both in favor of. So if market conditions change, it's worth taking the 5% withdrawal penalty to allocate to a product that would provide better long-term outcomes for whatever their plan is. It's an option. What I think I'm hearing from you is the compliance and the suitability requirements today are going to prevent churning if you're working at the right firm.
Correct. And quite honestly, the insurance companies realize that's a large risk. So they're very, very cognizant of that. And I think the other thing, and this is maybe part 2 of this, cut me off if we need to be cut off, but I think the other thing that we haven't talked about, we've really focused on the FIA as a bond alt, as a fixed income, right? With really just a very vanilla, no riders, just like 50% par was the one that we've talked about quite a bit on today's. But I think the other thing like if I was an RIA, over like to your point, the $100 million RIA, $150 million RIA out there that's trying to figure out how do I generate fixed income off of a portfolio that maximizes benefit to my clients. The thing we haven't talked about, which also is a big part of, say it's a 50-50 allocation where 50% is going to some form of fixed income. It might also make sense to diversify into an FIA because there's additional benefits. Some of these products have a floor and income benefit built into them. So you've got the ability to turn on lifetime income to where if you bleed that $100,000 annuity down to zero, you call up your client, you say, come in, I'm going to give you a high five because we exhausted all your money. Now we're into the insurance company's pocket, right? There's other products out there that have home health care. That's a really big one. There's a lot of risk out there that most people just ignore unless they were forward thinking enough to go buy an LTC, some sort of coverage like 10 years ago when it was actually affordable. But say you say, I want to take a portion of this fixed income inside the portfolio. I want to hedge against home health care. So many of the products have, if you can't perform 2 of 6 ADLs, it actually takes that income benefit and doubles it for a set part of time for the individual and the spouse, depends on how you structure it. So you can really hedge against multiple risks where, you buy an LTC policy and you die and you never use it. That was money that just went down the drain. Where in many of these products, you still get the cash value of whatever's left in the annuity, where you didn't use that LTC benefit that was unneeded, assuming it was. So we're starting at 101. You can go 201, 301 in these products, which I guess if there's one piece of advice that I would give to your audience is if there was one thing in this whole conversation that made sense where it's like, I am struggling to get a decent fixed income for my clients' portfolios. Maybe this is worth exploring. I would explore it with an unbiased. And then if there's additional benefits that might come along with that, like some sort of home health care coverage or some additional death benefit that could also be a benefit to my clients, I would just explore it, right? That doesn't mean you're going to go reallocate a bunch of your clients' money into this option or this tool, but hey, it's worth at least knowing what the options are out there.
So Brad, kind of wrapping this up, here are my 2 big takeaways from this. First, my biases generally were unfounded, and it really gets down to understanding the products and what you're doing, whether you're talking about insurance, a hedge fund, or a simple rules-based dividend portfolio. And second, really my biggest takeaway about these products that's going to require more research on my end is the fact that they can help diversify the fixed income risk in a portfolio and specifically not replace it. So, through that, if somebody's listening to this podcast, they want to learn more, they want to partner with somebody, something your firm does, could you walk somebody through what it looks like partnering with Advisors Excel and how they could get a hold of you?
Yeah, probably the easiest. I think it's kind of how we connected in the first place, Jay. It was on the Twitterverse, and then I think somewhere our podcasts merged. Actually, Jason Wink, I think, was the connector for us. But
that's right.
Yeah, I would. So here, exploratory with like zero work other than just throwing the headphones in. I did a podcast with Roger Ibbotson. It's been about a year ago, and it was just basically why index annuities are an alternative to bonds. And so, don't take my word for it. Take a guy that's a PhD, that's an academic that just did a bunch of math and research, and just listen to where he sees it's a fit. So my podcast is on bradleyjohnson.com, or just search for the Elite Advisor Blueprint out on wherever you listen to podcasts. I would just start there. That's nothing more than like 60 minutes of your time to explore it. if after listening to that, Roger was kind enough that his white paper here that I referenced a few times, it's a free download on that episode if you want to check it out and do a little bit more reading. And then if it makes sense and you want to continue the conversation out on the website, you can simply just connect with our team. And we're happy, especially if they're a listener of your show, Jay, that we'll hop on a Zoom and just walk through high level, see where it might fit for them.
Excellent. Brad, we covered a whole lot in this podcast. I'll have links to everything in the show notes. And listeners, please take a listen to Brad's podcast, The Elite Advisor Blueprint. You know, I'm a big advocate for all the podcasts in the space because there's so much great content out there. You want to make sure that you're listening to the resources that can have an impact on your practice. Brad, thanks for coming on.
Jay, it's been a pleasure, man. I appreciate it. And I appreciate the questions. You're doing a great service to your advisor community because you're going places a lot of guys haven't gone yet. And so you're out there exploring what is proper portfolio construction. I love the fact that you're just putting the biases on the shelf to go be a learner. So it's a testament to the job you do.
Excellent. Thanks, Brad.
See you, Jay.
The information provided is for educational and informational purposes only and does not constitute investment advice and should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult an attorney or tax advisor. Resilient Wealth LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Resilient Wealth and its representatives are properly licensed or exempt from licensure. For Resilient Wealth information, please visit Investment Advisor's public disclosure website at www.advisorinfo.sec.gov by searching Resilient Wealth CRD number 301986.